Hello, good afternoon. You've tuned into MF Corner on CNBC TV18. I'm Vinny Motiwala. With me is my colleague Sonal Luthra as always. Sonal, a very good afternoon. And viewers, good afternoon to you all because we're back with solving all your MF queries that you all have sent us. To do just that, we do have our experts joining us today. We have Prableen Bajpai, founder at FinFix Research and Analytics, as well as Nasser Salim, managing director at Flexi Capital, to answer all those mutual fund related queries. Nasser, as well as Prableen, a good afternoon. Thank you so much for joining us on the show as always. Let's quickly get started with those queries. We have a lot of queries that have come in and we want to cover as much as we can. So the first query for today, we have Neera, who is writing to us from Surat. And his first question, it's two-part question. One is, it revolves around insurance plan. He's asking if it would be wise to surrender traditional LIC endowment policy if already insured with an adequate term plan. Now, additionally, also more in terms of investing via SIPs in mutual funds, he's looking at Aditya Birla Sun Life Flexi Cap Fund, DSP Small Cap Fund, among others that he's mentioned. So he's saying his goal is to accumulate 3 crore rupees over 20 years, asking if this portfolio requires any change on both the points. Nasser, first up to you. Afternoon.
Good afternoon, Sonal and Vinny. Wonderful to be back on MF Corner. So, yeah, I know to Neerav's question, I think, the clear answer is if your protection need is already adequately covered through term insurance and plans, then an LIC endowment, for example, should be evaluated purely as an investment. And therefore, you need to compare the policy's expected long-term return versus alternative investments available. Neerav, and more importantly, most traditional endowment plans historically deliver low single-digit to mid-single-digit returns, so anywhere between 4 to 6 to 7 odd %. That's a very, very important point. The other quick point on this question on insurance is don't surrender blindly. Please check surrender value, paid-up options, tax implications, and obviously years already completed in the plan. As far as your portfolio is concerned, obviously you have the portfolio is diversified and has been held with discipline for nearly 9 years. Our only concern in this case would be overlaps. And I think that's where, overlap leads to over-diversification, which can be avoided. I think an SBI large cap, Mira large and mid cap, and an ABSL mid cap, and a Flexi cap that you already have meaningful exposure to large caps. And therefore, the issue is not fund quality. All the funds are credible. The issue is clearly overlap. And therefore, all these three companies, funds have larger exposures, and therefore suggested simplification is just keep one flexi cap, keep one large and mid cap in your from your chosen kitty, and keep one small cap, so that it's very simplified and not overlapping.
Okay, take that point. Let's go to the next query now. Kiran is writing to us from Chandigarh. She says she is considering to take a loan against mutual funds and adds that while top banks charge somewhere around 11 to 13% interest, some NBFCs and platforms like Volt Money offer it at around 6.5 to 7%. She asks if these NBFCs or platforms are viable options to take loans against. Prableen, we did discuss this actually in detail with our other guest, loans against mutual funds. But since this is a very specific query, let me get it addressed by you. Tell us, what do you make of this?
Right, Sonal. So Volt Money basically operates as an aggregator, and they bring together the customers who are looking to take loan against their mutual funds as well as NBFCs and banks. So Volt Money themselves are not an NBFC. So there's also the question on the safety or the default. So, that is something that they'll have to deal with. But of course, all the companies which are coming to provide that over there are regulated by RBI. Next, Sonal here, that she's mentioned that it's about a 6.5 to 7% what Volt Money is offering, but I was just checking the website myself, and they themselves say that, loans the interest starts at 9.99%. So I think what they're able to do when you have more lenders, they have these NBFCs and banks, probably they're able to give a better choice to the person who's coming on their platform because it's a technology platform, and also negotiate better rates. But at the same time, I don't think the difference is almost half, because she's mentioned like 6.5 for them and she's mentioning 11 to 13%. So there might be a 1 or 2% difference overall. But I think that, typically depends on her comfort if she's okay. Also, I would recommend that if in case, it's a very short-term requirement, then maybe some other options can also be exercised. And if there is a part of the portfolio that can also be sold, I'm also, I belong to the gang where I feel that not necessarily for everything a loan has to be taken. Maybe a part of the portfolio can be sold if there's something underperforming. So she must reevaluate, how she wants to meet the short-term need overall for funds.
Absolutely, point taken there, Prableen. Thanks so much for that. Let's move on then to the next query. This is an interesting one. We have Arman, who's age 23, is starting off his investment journey, and he has some doubts. Now, he wants to invest 5 lakh rupees over 6 months. Furthermore, he's saying that he's looking at a 10K SIP for the next 25 years. So he wants to do the SIP route as well as 5 lakhs investing over 6 tranches as well. His goal obviously is to move towards an SWP after 25 years and more on financial independence side as well. He's spoken about some of these fund names he wants to look at: Parag Parikh Flexi Cap, Kotak Large Cap and Mid Caps, Edelweiss Mid Cap and Bandhan Small Cap. He's looking at these names right now to invest in. Is this something good to look at? How should he go about it? Nasir, what's your view on this one? He's starting off right now.
Yes. So, the biggest asset that Arman has is not his choice of funds, but his age at 23. That's the biggest advantage he has, Vinny. And I think the fund selection is good because it covers broadly all major equity segments, flexi cap, large and mid and small. Any additional funds at this point of time, you just add to complexity without meaningful improving diversification. So our view is very, very simple. Again, 1 flexi, 1 mid, 1 small cap. Please continue what you've already shortlisted. I think the real driver in this case is what he clearly said, outlined, staying invested for 25 years. More importantly, increasing SIPs within these funds by at least 10 to 15% annually. So what we call is a step-up SIP annually. I think he will be closer to his goal and towards discipline. He will achieve his number.
Okay, take that point. As you said, you're right. It is the age which is on his side, Arman's side, that is, and he does have a lot of choices where he wants to invest in. Prableen, come in on this. What do you suggest Arman should do?
With the 25 years ahead of him, I think, Sonal, that the portfolio should be a mix of active and passive funds. So I would also recommend if, he can add maybe from the large cap space and even from the mid cap space, a passive fund, that would be ideal because it's a very, very long time horizon. And also the amount that he's investing. So, just because he's intending to do a systematic withdrawal later on. So as part of his portfolio, I would advocate to add some passives and also look at gold eventually and maybe something in the international space. As far as his, the SWP probably later after 25 years, what he's intending to do. Just a quick example, let's say today his expenses are roughly, let's say 50,000 a month. The same in the next 25 years would become 2,15,000. So the target that he wants to achieve in the next 48 years, because he wants to be financially free, there would be a requirement to create a corpus of roughly 10 crores. And that would require an investment of 55,000 as on date. So Sonal, I would also recommend Arman to keep a track of his plans in terms of doing his financial planning or retirement planning so that, he's the overall portfolio is aligned to the goals.
Absolutely. Aligning your portfolio to your goals is important as well. But on that note, let's move on to the next query. He still has age on his time. But the next query we have is from Jinesh, who is writing to us from Gujarat. This is an interesting one because it's around the commodity fund. They have invested 6 lakh rupees in Quant Commodity Fund and is asking if it's worth, still looking at and holding on to, and furthermore investable as well. We do not have details about any of their other portfolio holdings. But Nasir, what's your view? Quant Commodity Fund, obviously we have seen the swings coming in the commodity prices, gold, silver. When 2025, we saw that very sharp run up for a year, and then we've seen that decline, the volatility in terms of war. What should they be doing?
So very clearly, while the question is purely on just one quant commodity fund where he's taken exposure of about 6 odd lakhs, I think commodity prices are largely driven by global cycles, Vinny and Sonal, and inflation expectations and geopolitical events, right? Unlike businesses, commodities do not grow earnings or generate cash flows. Commodity funds are tactical allocations, which is very, very clear and not core portfolio holdings. We've been advocating this for a long, long time. Current commodity returns have been driven primarily by, as you rightly said, gold and precious metals. But commodity funds can also be very, very volatile, right? In the last 25 calendar year to now, if you see the last 18 months, we've seen their upswing and then, there's been a lot of FOMO participation also coming in. So, my only two thoughts on this. Historically, equities have been superior long-term wealth creators because earnings compound over time, Vinny, and while commodities are more cyclical. So keep commodity exposures to not more than 10% of your overall portfolio, which means that if you have 6 lakhs in this, I'm assuming that your overall portfolio is 60 lakhs, and therefore the exposure in commodities that you're participating in this through a fund or through gold and silver should not be more than at max 10%. Commodities are excellent diversifiers, Vinny, but equities remain the primary engine of long-term wealth creation.
Okay, take that point. So we've answered quite a bit of queries for today, but we have to take a quick break before we head to the other set, and we'll answer more queries on the other side of the short commercial break. Welcome back. You're still tuned into MF Corner. We still have with us Prableen Bajpai, founder at FinFix Research and Analytics, and Nasser Salim, who is the managing director at Flexi Capital, and they're answering all your individual mutual fund queries. Prableen, let me begin with you. Akshay is writing to us from Mumbai. He says he's investing more than 3,50,000 rupees in mutual funds. Of the total amount, he has invested in some funds through SIP, in some through lump sum. He says his goal is to accumulate around 8 crore rupees for a period of 22 years, and ask if his funds can achieve that corpus amount. So the list will come up for you on the screen. There's PPFAS Flexi Cap, DSP Multi Asset, Edelweiss Mid Cap, HDFC Small Cap, and the goal is 8 crore plus of a portfolio in the next 22 years. There's Kotak Multi Cap, there's Motilal Mid Cap. So it's a mix of a lot of these different categories. There's exposure to Flexi Cap, he has Multi Cap, the Small Cap. So it's covered mostly every category that one could look at. What do you suggest? Is this good enough to get to that the 8 crore mark in 22 years?
So it's a good target, Sonal, of 8 crores that he's looking to create for himself. And Akshay will have to increase his SIP from 12,100 with a 10% step up. He has to go up to 32,000 per month with the 10% step up. So there's a substantial increase in the SIP that he needs to do. And for the portfolio, I feel that with the 22-year horizon, and all this is calculated at 12% return, Sonal. And to reach there, he has a small cap, he has one mid cap SIP, he has the flexi cap, which is partially doing the work of a large cap as well. But I think with this sort of a horizon, maybe he can add an SIP in his multi cap, which he's invested in only as a lump sum. So that can be added. And of course, I would again advocate to have a mix of active and passive funds. So going forward, a pure active fund can also be added, which can be the Nifty 50 equal weight strategy, and a bit of gold. Maybe not at this point when we are facing, a huge the crisis of high rupee depreciation. But going forward, yeah, that can be done as well.
Okay, point taken there. That's a view coming in here. But the next query, let's move on and talk about the next query. This is from Rajesh, who's writing to us from BR. He is planning to invest 2 lakh rupees in mutual funds over a period of 8 to 10 years. He adds that he wants to allocate 50% to small cap fund, and the remaining is 50% to flexi cap fund. He's given 2 names also that he's looking at: Mirai Asset Small Cap Fund as well as Invesco India Flexi Cap Fund he's looking at. So given this current environment, current scenario, are these 2 good funds to look at? Is the strategy right? Should there be any change in this one? Nasser, what's your view?
Yeah, so, Vinny, as far as Rajesh is concerned, I think I would slightly reduce between Mirai Asset Small Cap, which is currently at 50, and Invesco India Flexi Cap at 50%. We're fine with the choice of fund, but I would definitely reduce small cap allocation because small caps have produced the highest long-term returns, but they've also experienced the highest volatility and deepest drawdowns. For an 8 to 10-year horizon, a 30-35% small cap is fairly reasonable timeline. The balance can be in a 65 to 70% flexi cap. Flexi cap, of course, comes in with its own benefits. The fund manager has choices to move between large, mid, and small. So there will be some overlap in flexi cap there as well, which will have some small cap exposures. A 35 small to 65 in flexi cap is a more balanced allocation. Which will give investors and, Rajesh, the pure diversification in this case and valuation flexibility, which you will enjoy. And a small cap allocation, therefore, retains also growth potential. Very, very simple. if you look at all the returns between flexi cap, mid and small cap obviously has given the highest returns, as evident from past historical returns.
Okay, take that point. Let's go to the next query. Meher Chand is writing to us from Vishakhapatnam. She says, as she's retiring soon, can she invest in Edelweiss US Technologies equity funds of fund to supplement her income source? She adds if some other fund would work better to generate additional income. A lot of these international funds are shut for subscription, and Edelweiss is also one of them. But if somebody had to plan for retirement, Prableen, what would your suggestion be? And if at all the subscriptions open or the LRS limit is increased, do you think these international funds are worth looking at from a retirement perspective?
All right, Sonal. So definitely international funds do make a lot of sense, but if, we don't really know how much portfolio she has, and, overall, it needs to be a diversified portfolio to manage your retirement and across different buckets, in the sense that it has to be something in the low volatility bucket, and then you have something for your SWPs if you're looking to supplement your, let's say, pension, or if you're looking to generate a monthly income, and then something in the hybrids, and then comes the equity part. So the international fund would, as it is, become a part of the equity part, which is with a long-term view, and then later you can definitely start an SWP from there. And given the limitations that we have, because the $8 billion limit is already breached, Sonal, I think the GIFT City route will be a better choice to take international exposure, and that too, at least with a 4 to 6 year view. Of course, we've seen international funds do really well, so there's a lot of recency bias there as well. But I would really advocate, in between what we saw in 22, we did see US markets take a deep cut, and the returns were really, everything was a negative at that time. Nasdaq had fallen by roughly 30%. So I feel that they'll give the same sort of volatility like equity, even the Indian equities. So it has to be part of the third bucket, and thus it cannot be the only exposure. The question is only related to this. So definitely yes, international exposure as part of your overall portfolio, part of your third bucket for retirement purposes, and has to be a smaller component of the overall portfolio.
Nasir, what's your view for Meher, right? She's retiring soon, looking to invest in that Edelweiss US tech equity funds, fund of fund, to supplement her income. Is that something that you would advise to generate this additional income?
Very clearly, for Meher, I would not at all advocate for any technology funds, because these are not for income generation, because that's a specific question. Technology funds are concentrated, highly volatile, and designed for growth. Retirement portfolios require stability, liquidity, and what we know as sustainable withdrawal capabilities. And I think given some of these tech plays, we've seen them in the past, highly volatile, very concentrated bets meant for growth and multi-baggers. I think for retirement income, we prefer very, very simple balance advantage, multi-asset funds, which are dynamically, which manage risk and can provide smoother investment journeys during retirement stages. So, categories such as BAF, which has been pretty active predominantly with where we've seen a lot of retirement benefits coming in. I mean, a lot of people who've been looking at retirement are looking at BAF as a category. Then there are multi-assets which look between multiple, asset allocations between gold, silver, commodities. We've got fixed income and some equity as well spruced in there. And then, between a combination of these, once you're at the vesting stage, you put in money in vesting stage. And then when you come out the drawdown stage, you adopt a SWP strategy from them for liquidity generation. I think, my recommendation to her is keep it very simple. Don't look at, aggressive bets on at least the retirement kitty.
Okay, take that point. So let's go to the next query that we have now. Rohan writes to us from Chennai. He asks if HDFC FlexiCap Fund is a good fund to start with SIP investments. There needs to be some more details as to for how long is he looking at this one. But for now, is this a good starting point if somebody is looking at the HDFC FlexiCap Fund, or do you think probably PPFAS would be a better fit?
Okay, of course, these
Prableen,
two have been pretty close. Yeah. Sonal, I'm able to hear you. So yeah, between the two, I think they've been close competitors, and I think it's a good starting point that he's starting with equity investing. That's more important, Sonal, over here. And I think a flexi-cap space is a decent starting point because you definitely get exposure to equities, but primarily what we've seen is majority of the large caps are large cap tilted, like the HDFC fund. So I think HDFC has a very credible record in terms of its performance, and in terms of rolling returns over the years, it's done quite well. So definitely can be a starting point, but eventually Rohan must look at his own financial planning, see how long his horizon is. And even for this particular fund, his horizon must be at least 5 years, not lesser than that. So please don't expect immediate returns. In fact, for even 1 to 3 years, your SIP may give you very low negative or single digit meager returns. So please do stick to your SIP during tough times.
Okay, stick to your SIP during tough times. That's the word there. But that was actually the last query for today. So Prableen as well as Nasir, thank you so much for joining us on the show and helping our viewers get answers to all their MF related queries. Thanks so much for that. And with that, viewers, thank you so much for tuning in. As always, up next, we have Closing Bell to take you through the last hour of trade.